call because I see people. Oh, thank you, Nick. I'll reintroduce. Welcome everyone to another Thursday night underwriting call. We missed last week, so I'm really excited to be here today. On this call, I love seeing the people that are committed to this call because this call is where I know people want to get to the next level, right? Because Monday nights, I do a call. It's very introductory in nature. There's usually a speaker on the call, and everybody has a great time on there. But this call is where I know people want to get to the next level. And the purpose of this call is to get everyone to the same level of thinking as I have as fast as we can, right? And this year I've spent, I was just talking to my wife and we've been doing accounting. I've spent like $115,000+ on mentorship programs, traveling around to different conferences, going to conferences. And recently actually it's way more than 115 now. I just renewed my Grant Cardone Real Estate Club, 20K right there. And then I got invited to Rod's boardroom, another 15K there. And then I committed to Robert's mastermind, 7,500. So it's well over 130,000 or 140,000 at this point. And what has that equated to? That's equated to tripling, actually probably more than tripling my yearly income from last year, but also more than doubling my net worth. Being a general partner in 800+ units, right? So this is all, I'm going fast and I'm paying for speed. And you guys are also here. This is a shortcut. To be on a call with me here on Thursday night is a shortcut. Hold on, let me put this in speaker mode. Sorry. So this is a shortcut because everything that I've done up to this point, I want to get you guys to there as fast as we can. So when we talk about underwriting on this call, it literally is, it's not just underwriting, but it goes from everything from how you evaluate a deal to submitting your LOI, to putting it under contract with a PSA, to all the process in between up to closing. Okay, that's a whole game by itself. Getting to close is a whole game. And then you got a whole nother game, which is when you actually have the deal. There's a moment, I was sharing this with some people this past week. There is a moment before closing that you're like, oh shit, am I gonna get there? Like, especially if you're short, there is no stress like the stress of being short a week before closing and you're not there yet. And there is no more extensions. $330,000 on the line, right? There is that type of stress. Then there's another moment after you close on the deal, after you sign. So some of you guys that have bought, maybe if you've done single family, if you've done land, if you've done any sort of real estate transactions, on that day that you sign, there's a moment that's like, oh crap, now I own a property. Now I've been talking about this game plan, right, for the past whatever amount of months, and then now I own it. And what do I do with it now? Right, it's time to, so that's a whole nother game, but we're not going to talk about that game. We're going to talk about everything before closing. Before closing is a very, if you can get over this hurdle, if you can just do a deal in multifamily, it just gets easier and easier. All right. So I want to help you guys prepare to get there, because if we do a deal, actually not if, when we do a deal, those of you guys that are committed, when we do a deal, I want you guys to be there. I want your mindsets to be there. I want you to know as much, if not more than what I know, so that when we get into a deal, the understanding of a deal is not going to get in the way of the partnership, right? That sometimes gets in the way. I want our mindsets to be very close. I want us to think the same way, understand the same things. And as long as you guys are here, you guys are understanding, you guys are getting a shortcut to how I've gotten there. And I'll tell you right now, the first 3 deals that I got involved with in multifamily, I put no money down. I didn't have any money. So if you're in the space of I don't have money to do it, like just get that out now, because I went from 6 years ago being about $450,000 in debt and doing all this real estate, climbing back up to, wherever I am today, most of that journey was without my own money. Okay, so it's probably a couple $1 million worth without my own money. And now I want to participate with my money because money gets me there even faster. So I want to play in the risk capital side. I want to play in the anywhere that money could be involved, because the doubling of that money is faster. And I've shared with some of you guys before a while back how I participate in risk capital. And this is the way that you actually can get in a lot more deals faster. I say, hey, I have $100,000 ready for risk capital. Okay, who needs this money? Somebody is going to be doing a deal out there that needs 100K of risk money. I got it. Who's going to do a deal? Now I can vet the operators. I can vet the deal. I can vet the operators. See, the deal is coming to me, right? And so every one of you can position yourself in that way if you have money. If not, then what is it that you can offer? Because the goal of this call is to get you guys into a deal. Hey, I'm boots on the ground in Vegas. If anybody is doing a deal in Vegas, I'm your man. Hit me up, right? Get this out everywhere. Every single person should know that you are boots on the ground in Vegas. If you're like, I'm an awesome underwriter, I got all the time in the world, I just quit my job and I will underwrite the shit out of any deal. If you don't have time to underwrite a deal, let me know. I'll underwrite a deal for you. That's where this call becomes very interesting, because you got to know how to get through a deal quickly before you go and underwrite, spend an hour, 2 hours, 3 hours more on a deal, because you're going to have to talk to guys like Tanner, and Tanner's going to be speaking with me soon. He's right here, actually. Tanner, you're here. Great. I was kind of just talking to wait for you to get here. Okay,
yeah, I've been here.
Good. So a lot of people have been asking for your information, and I don't know, something with the email that went out last time. I think it may have ended in a lot of people's junk mails, or it might have not gone out correctly. But I'm so glad that you're here joining us.
I just put it
tonight.
I just put it in the chat again.
Okay, good.
Just so everyone can see it right now.
Yeah, everybody get that. Tanner, I'll introduce you in a second, but let me just finish what I was spieling about, right? So you need to know, if you're an underwriter, you need to know how to quickly analyze a property, a napkin way of underwriting. Okay, very simple way. You can look at location first. Okay, if you're going to do a deal with me, do not sacrifice on location. There's been a couple people that have been giving me a lot of deals, and the numbers are sort of penciling out, but it's in a very rough location. And I don't really want to be doing a deal in a rough location, even though, it's hard to find a good deal to pencil out right now. I still rather not sacrifice location for cash flow. Okay. I'm not that concerned about cash flow right now. I'm concerned about having a good location so that when the interest rates come back, when the market turn back around, my property is the first one to go back. Okay. I don't want to be struggling and fighting with a, I don't know, C minus D neighborhood type of property. So, there's been some people that have been, on my calls for a while, and you're on these, and I know you, I see your names. So when you send me deals, I'm obviously going to take more of a look into it than just somebody that's just spamming me deals. Okay. There are plenty of people out there that's also just spamming me deals without any sort of wanting to connect. This is a relationship game. If you've been on my calls, I'm about relationships more than deals or anything like that. So if we haven't developed a relationship, you can't expect me to spend that much time on your deals, right? It's logic. It's logical. So yeah, this call, I've seen there's been a huge, I've been feeling a lot of support, and a lot of people have really, really reached out to me, and I've built a deeper relationship with many of you guys here, and I'm super grateful for that. I look forward to, looking back a year or 2 years from now, and us talking about, hey, remember the underwriting deal, your first year doing underwriting, your first year doing your mastermind, People that were there for that whole thing and we're in just big deals together. I keep seeing that vision, and I keep seeing the people that are with me, the people that are supporting me now and wanting to build a deeper relationship with me. Like I see that, and I see us with deals. So that's something that I always see in my mind. And I want to build as deep of a relationship as I can with every single person that's here. And this is my invitation to you guys to reach out to me. Invitation to set up one-on-one calls with me. It doesn't even matter if you feel like you're ready or not. Every one of you is closer to being in the deal than you even can imagine. Like every one of you. And like I was saying before, do you have time? Do you have experience? Do you have money? These are the three ways that you get into a deal. One of my really good buddies that's here with me in Hawaii right now, we're talking about exchanging equity, okay, position in the deal for video production, social media, something, right? He's a great video editor. He's produced movies, documentaries, and that's definitely valuable to my business, to my empire, right? I'm willing to give up pieces of my deal for that. And so everybody here, every one of you guys has something to offer, has a gift. You have to leverage your gift. Every single person needs to know what your gift is. And then that's how you get into a deal. Let deals come to you rather than you go out fetching deals and begging for deals. All right, because it's just not as effective. When you tell people what you got, I got $100,000 risk capital. Who needs me? I guarantee you post that in one of the chats that we're in, there's going to be at least 5 or 6 people asking you. Now, I don't encourage this, but even if you didn't have the money and you think you can get the money, you can still say that too. That's a riskier game, but it comes down to where would you go? How far will you go? What are you willing to do to be in a deal? What are you willing to do to make it happen? That's the closer than you think. Everybody's got resources, got gifts. Okay. So if you're not in a deal right now, ask yourself why. And there's going to be some sort of excuse, and just take that excuse and throw it out the door. All right. And just be like, I'm getting into a deal. I have a gift. I have what it takes, and get in a deal. Okay. So that's my attempt to be motivational and inspirational to start this call. But I do want to give you guys some how-tos and some knowledgeable things that you can actually implement, or something that you can learn and then implement into a deal now, into the way you underwrite a deal, into the way that you are a partner with somebody. And I may get to a point where I'm going to draw something on my iPad, but I do want to have Tanner, while he's here with us, speak about some things that are going on in the market, talk a little bit about maybe what we're expecting, different ways of looking at how to finance a deal in today's market. And personally, I believe that in the next 12 months, 18 months, 24 months, there's going to be life-changing deals. And the life-changing deals are going to come with creative financing. Creative financing, meaning that you could probably be in a deal with very little money without having a bank approve you. That's one of the biggest hurdles is, can you get approved for a loan? If it was a Fannie Freddie loan, I'm not 100% sure I would get approved for it. This $5 million deal that I'm about to get under contract this next week. I don't know. But, this is why in this market, it's so exciting. There should be no excuses. Every one of us can get into a deal.
Yeah.
All right. Just cool. So Tanner, why don't you introduce yourself a little bit for anyone that doesn't know you, but you're already a fan favorite amongst people on this call. I hear people asking for your name all the time.
Perfect. I'm ready to serve. So
Nice.
Yeah, my name's Tanner Banning. I sit in Cleveland, Ohio, and I work for a small debt and equity origination shop called Atlas Real Estate Capital. We're headquartered down in Sarasota, where both partners live, but we do deals nationwide. And pretty much, if you're looking for a loan, we can help you find one. Usually I provide the most value on a loan of $1 million and up, just because kind of the cost outweighs the benefit once it gets a little below that. But I'm always ready to opine or just talk deals, because that's pretty much what I do all day. Lately, I've been seeing a lot more deals come in, whether that's refis with people who have maybe floating rate debt or might be in a little bit of a position where their rents aren't popping what they thought they would, or if their preferred equity provider is saying you got to sell now, and that's pretty much what they've got to deal with. We're seeing a lot of those, but we're also seeing a lot of people come and say, hey, we've got this amazing deal. How can we get this done without having to spend 90 days trying to close a loan, underwriting, every single thing I've ever done in my life, which is not far off from how intensive agency underwriting can be. That's kind of where I add a lot of value, is knowing what they're looking for and also what they're not going to be looking for. So I think that my favorite right now is still definitely seller financing. We've probably talked seller financing more over the last 3 months than the last 3 years combined, simply because of where interest rates are at on the conventional side. But we're in a really interesting place now, because where there's interest rates that are rising, which is not excellent for borrowers, but when you're trying to convince a seller to carry paper, they might say, oh, well, I can just reinvest this at a risk-free rate. But they're kind of missing the entire point of real estate, is if you're seller financing, then there's still like the ability for you to realize increased gains over just taking your normal, 4 or 5% in your treasuries or what have you, or stocks. So that's what we've been talking a ton with sellers, is if they don't have to pay off their current loan, which is usually the number one objection from a seller, is, well, I don't really have a choice to do seller financing. We've got to pay off our lender before our rate goes up more. So we're seeing so many deals flood the market essentially right now. Cap rates are starting to, bump up a little bit, which is nice for investors, in my opinion, on buying deals at a lower basis. Another one that I wanted to talk about is they have a lot. It is technically conventional financing, but SBA loans, USDA loans. USDA is one I've been talking a lot more recently. That only is available in rural areas, but it's very interesting because you can do ground up construction, you can do hard renovation, or you can just kind of buy the deal in and of itself. So I've been on calls with a couple USDA and SBA lenders recently, because typically as conventional rates rise, that more unique financing becomes a lot more attractive. They're getting a lot busier right now, just kind of based on where their pricing's at versus normal banks.
Yeah, so can you just give a little bit of a difference on SBA, USDA versus your conventional lending right now?
Right. I'd say the biggest difference is really like their programs. So USDA has to be rural, like you're going to have a population cap. That's one of the main things that, like, right off the bat, people kind of run into. They also want you to be a local sponsor. That's another kind of thing there. SBA loans, I do not believe you have to be a local sponsor necessarily. They do want someone on the team to be local. Typically, SBA and USDA rates are typically higher than any conventional bank loan, but they also can offer a little bit higher leverage, sometimes longer amortizations. There's different pieces of that capital stack, or capital group, that you can kind of utilize that aren't going to require as much capital down as a normal bank loan.
Nice.
Yep.
Yeah. So for
I was going to kind of go into rates over the last couple of weeks, but
Okay, yeah. So let me just preface some things here for the people that are on this call. So I was at Rod's boardroom last weekend, I think.
Yes.
Um, and this was full of people that are playing at a really high level. I mean, I literally think somebody in that room wrote a $10 million check to somebody else. And it was kind of ridiculous, sitting around those people. And the part that I really got lost at was when they were talking about the way they put deals together. All right. And for me, I've gone very fast. I've been in real estate for many, many years. And I couldn't understand half the things that were said in there. But afterwards, like there were so many, those are the indicators of things that I needed to learn. So I went home, I looked them up, I got a good understanding of things. I'm like, oh yeah, this is how this and this fit together. So for any of you guys that are here, and if Tanner is saying something that you don't understand, because especially on the finance side, this is a lot of like confusing shit. Okay. Everything's changing all the time too. So to follow something like this is challenging, but having a basic understanding of it is really important because you don't need to know everything. You just need to know somebody like Tanner. He's going to be able to handle that for you. Like I have a deal that we're looking for some debt on right now, and he's handling all that. He's telling me, okay, these are what this is the information you need to get for me. This is what the banks are going to be looking for. So he can help me prepare to get ready to submit my loan docs, right? And yeah, so that's really important. I just wanted to say that for people
Yeah.
that might be sitting here like, what's going on?
Yeah. Another quick comment is, if we've reviewed a deal and we've looked at it and we say, this is going to work, we're going to be able to get a loan for that. We oftentimes send out pre-approval letters. It's more of a residential thing, but sometimes brokers are just looking for a little bit more when it comes to taking an LOI, and that's been helpful before too.
Yeah. So somebody asked, Ben asked, if assuming a loan, would the lending criteria be the same as the original loan based on today's market requirements?
So yes, I would say yes. You need to be, meeting the kind of same lending criteria. There's kind of two pieces to assuming a loan, in the way that I kind of look at it is you've got your assumption, but you also usually have some sort of supplemental to go along with it. And that kind of muddies the waters when it comes to requirements. I would say yes is really there. They're not going to order all new reports like environmental, property condition. You're not going to need those, but they will do a new appraisal. So it kind of the loan dollars will usually follow the appraisal.
Okay, so let me ask you this, because I am going through this exact process right now.
Yep.
And maybe this live example will help people understand it a little bit. So I have a $5 million deal in Las Vegas that I'm negotiating on. I can either take over the LLC or I can assume the loan. These are kind of what the seller wants us to go through, and kind of us too, because it's a 4.2% Freddie loan, 7 more years fixed. It's the IO period is over, but I did my underwriting based on today's interest rates. If I got a new loan and I took the interest only for whatever X amount of years, it comes out to be about the same. But the seller is willing to come down to, we're trying to negotiate under $5 million. He wants 5.75 right now. He's got a $2.45 million loan. Okay, so if I was to assume this loan, I need to come up with about $2.5 million. The criteria for a Freddie assumption loan is basically the same as a new deal. And so you got to go through that you got to be underwritten entirely, our whole team, as they will underwrite a new deal, right?
Yep, exactly.
Okay. All right. And then what was, okay, go ahead.
One tough part is not supplemental won't always be available depending on how long it's been. I've been looking at a couple assumptions where they literally bought the property 6 months ago. To do a supplemental, which is basically, another loan on top that goes on the same, it needs to be 12 months later. Obviously that's not an issue in your case, but just something I've seen recently. And then what was the
So
last one?
you mentioned a new appraisal needs to come out. What are some of the things that may happen on this deal if I go the route of taking, assuming the loan? Because I have an option right now to assume the loan or just buy the LLC. The assuming the loan is going to cost me a bunch more money, but I would feel, the peace of mind would be a little bit more there. And only because, if the lender were to call a due on sale, use that clause, then I would need to like come up with another 2.5 million or something. So I'm weighing out the risk and rewards here. I do think both. I mean, I'm willing to go to the loan assumption. Now, the new appraisal, what are some of the things that can happen on this deal?
Well, there's really two things. Well, there's three things. It stays the same, it's higher, or it's lower. If it's lower than kind of as before, there isn't a chance that they're going to require you to bring a little extra capital and pay down the loan a little bit. So, let's say you find a smoking deal, buying it for 3 million, the loan balance is 2.9 million. They're
Well,
going
let's go. Hold on. Let's keep this going on this deal. So I got the $5 million deal. They have a $2.45 million loan on this.
Yep.
Okay. If I buy the LLC, I'm basically going to be coming up with 2.5 million. So I don't see me going any more than that, even if I assume the loan. Right.
Right. But
so that's the max.
Yeah. In this situation, that would be the max if you really took just the assumption. That's because it's Freddie. Freddie supplemental is not a thing. Fannie, it is. That's one of the main differences between those two.
Yeah.
So,
wow. Okay.
Yeah, it's a massive difference, and it's one reason why a lot of people go Fannie, even though you're usually looking at a little bit different kind of loan. It's usually always yield maintenance.
What does that mean? Yield maintenance.
Yield maintenance is a type of prepay. And basically, if rates haven't stayed the same or if they've plummeted, you're going to have a tough time selling because yield maintenance is a really, really expensive prepayment penalty. That's
okay.
The high level.
Let me make sure that it isn't Freddie. I actually not 100% sure if it was Freddie or Fannie, because I know they have an issue with this prepayment penalty if they were to sell it. And that's why they're willing to come down in price if I did the loan assumption or buy out the LLC.
Exactly. Yeah, I believe that 100% because, from their chair, it's we make this amount of money or we make this amount less because we have to prepay our loan.
Yeah. Gotcha.
Yeah, I can look it up too if you have the address.
Yeah, so it is. All right, everybody. Don't try to steal this deal from me. Just kidding. It ain't happening. I have a great relationship with them. Just kidding. If we're gonna do a deal, we do it together. So I think it's 518 Ogden. So if any of you guys here are confused or have any questions based on what we're saying right now, this is a great time to be asking, like anything. So hold on, let me just double check the address.
518 Ogden.
I'm about 70% sure.
It's not coming up. So
yeah, hold on. It's probably my memory not serving me correctly. One sec. Oh, 813 Ogden, Ogden. That was close, huh? 516, 813.
Excellent. Yep. I'm pulling it up right now. So they only got 4.4% rate. Love that. Although we have seen over the last couple of weeks, the treasuries come down a little bit. It's been a good couple of weeks for interest rates, no question.
Yeah, let's talk about that a little bit too.
That's what really excites me.
I think that is a very exciting thing right now.
A nice respite from just constant increase. But basically, I think I touched on it last time. We had CPI, the inflation and jobs come out, and it looked like inflation was starting to soften a little bit, and that's mostly what's led to the decrease.
So for everybody, CPI is the Consumer Price Index. It basically shows you how much things are costing a household when they're really going out buying things. So like food, gas, transportation, like all sorts of things. They have a formula that I don't really understand how they calculate it, but basically it comes out to a certain percentage, and they want to see it to be lower than expected, or they wanted to see that number come down. Am I
Yeah,
correct on that, Tanner?
bang on.
Nice. So they're looking at the CPI and they're looking at the unemployment rate, right?
Yep. Yep.
Okay.
Yep. The
And
most recent jobs report, I think, was decent growth, but mostly it was part-time changes. I didn't see much in full-time employment, which is typically what's going to move the market on.
so I mean, literally, I'm reading articles everywhere that every tech company is just laying off huge amounts of people, like 13,000 people that Facebook or Meta is letting go. I think like every company has some crazy amount of people that they're letting go. So is it reflective of the number they're showing, or is there a lag?
There
That
is a
like maybe
lag. I
there is a
like how
lag.
you
Okay.
mentioned, like, we don't know how they calculate CPI. There's a lot of discussion about that because a number of people believe that they're not using the most up-to-date information. Their information's lagged, they're faulty formulas, they're outdated. A lot of people try to read between the lines when it comes to that data. I
Yeah.
just try to stay high level.
Yeah, that's the way to play the game. Okay, so for everybody, play the game at a high level, right? Don't go into the nitty gritties and complain about how the government is calculating and all of that, because you can't do anything about it. All right, so don't
Yeah.
play that game. Play at the high level, like, okay, well, they see it this way. Okay, well, where is it going? All right, where is it going? Um, cool. Yeah, that's a good link right there.
Definitely.
Yeah. So part-time increase, but you are seeing that there's a whole ton of people being laid off, right?
Indeed.
Like at least in the news.
A lot of velocity of job changes right now too.
Yeah. Cool. So is it just the tech market that you're seeing that happening for, or is it happening across
Well,
the board everywhere?
one other category that I always watch is the like HR recruiting category, because I've
Mm,
seen a couple of companies completely lay off their recruiting staff, and that's a clear indication that they're not looking to hire. It doesn't mean they're going to be laying off more, but that's a classic indicator. We've seen a lot of the REITs offload their development slash like unique property stuff. People tasked with creating a new movie theater or something like that. They're just not so interested in your unique projects right now because of the risk.
yeah. Now I read somewhere else that people are kind of like, or the market's kind of waiting for the hedge funds or whatever to come back in and start moving the market again. Is that something that's also happening, or is it
It
a
is.
factor?
It's definitely a factor. The REITs have been falling for sure, which a lot of people think will be followed by the private market, but the private market takes a long time to adjust compared to bonds or stocks or basically any other security on the planet.
Mm.
It's just so unique that all of the trends are going to be, location driven, size driven, and of course, like market driven.
Yeah.
So it
So
affects them all
uh-huh.
different.
What would be what would be the indicator that we want to look for now that kind of gives us like a sneak peek into the future? Like what's the greatest indicator to look for?
I watch what's called the forward yield curve when it comes to
Oh,
interest rates. Actually, let me get
you want to
this.
share?
Yeah.
You want to share a screen? All right, let me give you some
Yeah,
share
I can
screen
share a
skills.
screen, and I'm also going to put the link. So this is the US forward curves or the yield curve. These aren't necessarily predictions. The way that these rates come about is based on futures trading. So it is based on, a market of trading securities. But this isn't like, hey, this is what we think is going to happen. This is all of the money behind futures is predicting this to happen. That's most likely what's going to happen. So Am I good to share screen now?
You're good to share.
Cool.
I really feel like what you're about to tell us right now is some super gold nuggets. Get your papers and pens ready.
Okay. So
All right.
this is the link that I sent out, but I already unselected all of the other ones that usually pop up. I only care about 1 month terms, so forth. And this is based on all of that trading and all those super smart people making decisions on a lot of money. This is what they're sort of thinking. Now, I've highlighted 4.97% May 2023. 2 weeks ago, when I was looking at this, their expected high was 5.17%, so 20 basis points higher. And it also occurred in July 2023. So I think really the signs that I'm seeing are recent inflation data is starting to curb a little bit. I'm thinking the downslide of prices is going to be a little bit less pronounced because we're not thinking rates are going to be high forever. The shorter amount of time they're going to be high, the better.
So you're looking at this coming down. So you are, based on this chart right here, bullish on the interest rates are going to come back down
right
in the future at some point.
Yeah. So for the first 10 months of 2022, I was not looking at floating rate debt as a good thing. Obviously, those have skyrocketed. But if you're closing on it now, there's only so much higher they're predicting it to go. I'm actually just closing on my first syndication in Indianapolis right now. And although it's floating rate debt, we're going to be locking in at starting at 4% SOFR. So our total all in is about 9.25. I've already built into my model that our rate's going to go to 10.25 in May 23, but we're going to kind of adjust downwards after that. And then we'll hit our refi period here. So my recommendation is whenever you're looking at underwriting a loan, look into the future. Don't just assume that it will stay the same. Those are a lot of the mistakes I saw on, the SDAs and all that kind of stuff early in the year. Is if you're predicting SOFR to stay the same and SOFR is this rate that we're graphing, then you kind of got burned a little bit.
Yeah. So if we were looking at this chart, let's go to, well, it doesn't go further back, but it goes from now. Oh, it does. Okay.
I would go to a different chart.
Right. Okay. So let's just kind of try to predict the future a little bit here. And so you guys are hearing it right here, the prediction from Tanner. What is happening in 2023 and 2024?
Yep.
So if we go floating rate right now, we go floating rate, and what do we think is going to happen?
Right. I think that there still will be a good period of rate hikes through July 2023 when we talk about the Fed making decisions. Like when everyone talks about the Fed hiked rate, I think that will continue to happening through Q2, probably Q3. That's the sentiment from the Fed themselves. They kind of indicate what they're going to be looking at doing. I think we're going to see long-term rates continue to rise probably through next summer, just so they can be sure that they're kind of getting the bear off the back. That's my personal prediction. But I will say, if I knew the answer, I would be a billionaire.
Well, okay, so let's make that happen. Let's become billionaires in this next whatever period of time. So for anybody that's looking at deals now, okay, and for myself too, what type of a lot of people are talking and are afraid of the floating debt. So for anyone that doesn't understand, floating debt means it's kind of just going with the market.
Yeah.
All right.
Changes every month.
Yeah, it changes every month. So your loan payment changes every month. And something else that could happen is they might ask you to have more in reserve every month. Like things could change. Am I correct on that? I feel like I've heard people.
That's something we've started to see a lot more recently, that wasn't a thing in 2021 because rates stayed so low. But
Yeah. So
basically,
what could happen? Yeah. What could
now,
happen?
most of those kinds of loans have some sort of interest reserve. So as your, typical monthly payment increases, you're going to have to actually fund that interest reserve. So if my original rate was 5% and it was 10 months of, 5% and we had 500,000 or whatever, if my rate goes up to 10%, I'm going to have to double my reserve because the 3 months of loan payments are double now from 5 to 10%. So
Yeah.
we've seen a lot of instances where borrowers not only aren't being able to kind of increase their cash flow, but they're actually getting, a lot of it taken away from them.
Yeah. They're getting crushed. They're getting
put
crushed
into the
because of that interest reserve they got to put away. I
Mhm.
mean, I think
It
Rod was
stunts
saying that
their growth a lot.
yeah.
Like,
Well, somebody's went from like 8,000 to like 50,000 or something like that.
yeah,
That's, I mean, think about that, like that kind of dent to your cash flow. It's not only do you have to pay more to the bank for the interest rate, but now you got to put more into the reserves that they require from you. I mean, how
yeah. Once
this
you
is
look at
why,
those monthly outflows, it becomes concerning because
yeah,
you're like, it's my money. Let me, do my thing. I'm the property owner, and they really reel it back.
yeah. Wow. Okay. So,
So
back to
kind
that
of,
question.
yeah, tying a bow on this interest rate prediction. Um, Up until very recently, my thought was no floating rate, no bridge. It's too risky. But really, as long as you're modeling it conservatively based on kind of this yield curve, you know what you're getting into, and you know how quickly you can renovate, I'd be confident in yourself. At the end of the day, I'd say that to a lot of clients because they ask me what I would do, and I ask them, what would you do? Because I also look to you all for advice constantly, whether it comes to business or rate or what have you. Because I look at this stuff a little differently than the average investor, kind of as like the lender viewpoint.
Yeah.
Mhm.
Great. So very good to have you in our corner. Um, so let's go back a little bit also to talk about the different types of financing, because we've covered some sort of seller financing at this point. We've covered loan assumptions. One of the ways that has been, that I'm thinking is like when we make an offer in a deal, we should be making an all cash, like low ball offer in today's market. And let me know what you think about this. So you offer a low ball cash offer, and then you offer a little bit higher with new debt, whatever it is that you've underwritten at, or whatever got someone like Tanner is telling you that you're going to get your debt at. And then you can offer seller financing, right? This is where it gets interesting. Hey, seller, I want to give you what you want. I want us to both be happy on this deal, but I can't because the bank is not letting me. I would love to, but the bank's not letting me. And this is all the cash that I got to buy this deal. Okay. And then you can work out something with the seller. And that's the seller financing part. We're actually going to go back to our seller from this four-pier storage deal, actually, and we're going to ask them to carry on more debt. Let's see if he will go for this too, and come into second position to a construction loan, so we don't have to raise any CapEx money. So we'll see if, and then maybe if he wants to, get in on the deal, come back in as an LP as well for the seller. So there's just so much that people are entertaining right now because they can't sell the property the way they want to. And a lot of people, I think the statistic was there's like trillions of dollars in floating debt that's coming due in the next couple of years, right? Or this year or next year.
Yeah. Yeah. A lot of
Yeah.
the Wall Street mortgage-backed security stuff too. A lot of that's going to start coming due. And some of those properties are still feeling the effects of the pandemic. Like it's long reverberations kind of back to the private real estate market reacts slower than maybe any market of anything.
Right. Wow. So let me see here. Now there's the loan assumption, there is buying the LLC, there is some sort of seller financing where they hold on to the note There's a bunch of different ways to that. You can do some sort of master lease option, right? Which you don't even conduct the sale. You put a purchase, a promise of purchase down the road, that you create some sort of cash flow for the seller and you take control of the property. Now you can go and implement your business strategy, create more income on the property. You still have this promise to buy, this agreement to buy, and you can go and refinance when you're ready, or when you can purchase when the market maybe becomes more friendly to you.
No doubt.
No doubt. So there are some other ways, and we talked, and I think it's good for people to understand this, even if you're not going to be doing it right now. So Tanner didn't really want to talk about this, but I think it's still good for us to hear, is deals that are like $20,000, $30,000 or more, where you start to get other players in that come into the capital stack. All right, so the capital stack is all the money you need to buy a deal. That includes the first position is Fannie, Freddie, whatever loan that you're going to be getting. And then there's second positions to those. Can you talk a little more about like pref equity and like the mezz debt and everything like that?
Yeah, mezz debt and pref equity is super interesting to me. It does introduce a little bit kind of handcuffs or a lack of decision making or agency. Like, you will kind of have to answer to a few more people. Obviously, having a whole nother lender on the deal or a whole nother, capital provider on the deal, you're going to have to give up a little bit of control. And that kind of goes back to relationships. You've got to develop that relationship so you're on the same page. But essentially, preferred equity is what it sounds like. That equity gets paid out before any other investor, essentially. The way they set it up, certain that they will be able to make decisions and they will control the final say, basically. So the preferred equity, or prefec, as a lot of people reference it, it comes from a lot of different places as well. That could be a family office. It could be literally just a large bank who's got a preferred equity arm. That they can be from a lot of different places. But I would say that they're going to be on top of your first loan. So let's say you're still going to have to bring some money, no question. You're still going to have to bring some money, but you're going to reduce that amount by a lot. So for example, if you're doing a bridge loan, you get 70% of your cost from the first mortgage, 10, 15, maybe 20% on the pref equity, and then you're bringing the last 10. It really depends on how you structure the deal. And then mezz debt is a very similar idea. Mezz stands for mezzanine. And basically mezz debt, it's not permitted over Fannie or Freddie. It's most commonly used on top of Wall Street money. So if you go to CMBS, the commercial mortgage-backed security market, maybe get 70% of the purchase price there. Mezzanine lender would take, the last 15 to 20% and bring you up to really high leverage. Preferred equity and mezzanine debt are both going to be in the double digits, no question. Even before a lot of these rate increases lately, that's just kind of the price of poker for them right now. Mezz debt most recently quoted, I was looking at like 12 to 13%. I was on a little bit smaller deal. As you get into kind of the big leagues on like 9-figure deals, it starts to become a lot more important.
Yeah, because these guys, what are some like, I know a lot of family offices, and we've been kind of talking to building these relationships in some of the bigger deals that we're getting involved in. They are like minimum, some of them like minimum 10 million or minimum 5 million, but preferably 10 million and up, right?
Mm-hmm. Yeah, because it's all the same amount of paperwork and loan closing like effort. So they don't want to get into smaller deals just because the check size is too small.
So if I was to bring a great $40-50 million deal, would you recommend me getting some pref or mezz debt on top of it?
That's a good question.
And would you be able to help me get it?
Yes. Mezz debt and pref equity, we've got both of those kind of in our holster. I would not recommend mezzanine debt, because if you brought me one of those deals, I would assume that you were planning on adding some value in some scenario. A lot of situations where you're going to use mezzanine debt is on a stabilized property that doesn't have a lot of value to be added. You're just looking for the best possible returns. So on like a very large office building in New York City, that, it's just, we're trying to get as much money so we don't have to put as much down. When it comes to preferred equity, that's probably what I would talk with you on. There's some preferred equity providers who are I wouldn't say a joy to work with, but you can really operate like on your own choices. And there's some who basically will tell you what to do. So that's like a big role that we play, is we're the middleman. We know exactly how they operate. If you're okay, listening to somebody else basically run your deal, then we would go with kind of the more aggressive ones. The ones that will direct you to do whatever they want. They're probably going to be the cheapest as far as their required returns, because they know they're going to control it and they don't have as high of a hurdle kind of when it comes to the return.
So what are we looking at for what's the damage here if we go with the preferred equity, like an aggressive versus let's just look at two spectrums, the most aggressive and the least aggressive.
It's really hard to get even into terms. It changes so much, even from like market to market, property type to property type kind of thing. Multifamily, yeah, they're usually going to be looking for their check size to be 10 plus. So it's usually, earlier this year, I started to see a little bit more preferred equity in the smaller space, and that stopped pretty quickly, just based on kind of the market. So they're looking to sign big checks, and their goal is to not have to do anything, but they really just set it up so they can choose to do whatever they need to.
Yeah, because one of the bigger guys that I was sitting down with, and this is the first, probably like 2 months ago, was when I first got exposed to preferred equity, and I was like trying to understand how it all worked on the capital stack side. He was basically saying, look, you do a $20 million deal and you need to raise 10 million, $11 million. He does a $90 million deal and raises about the same amount of money. And he's like, because of his relationships with different preferred equity family offices, they have a bunch that's just like ready to contribute to their deals. So once you get to this 50, the next step, if I go to 50 million, 60 million, because I haven't personally had the confidence to go there myself. I'm okay with piggybacking off somebody else and letting them figure that all out. And I just raise a couple $1 million. That's easy and that's fine for me. But if I was to lead one of those things and I go into 50, 60, $70 million deal, what would you, is this I'm looking for pref equity, right?
Right.
For sure.
Yeah, if you're doing that size deal, I think that preferred equity is definitely a good option for you, because it helps you kind of get your leg up. They're usually looking for experienced operators. And if you can show them, look, I've been doing this for a long time, like decades, that's what they love. Or you can partner with someone who's been doing it for decades. That's another thing that they love. So I guess to your point, I really wouldn't worry so much about the deal size or anything like that. I would worry about how good the deal is.
Yeah. Okay. So you guys heard it.
Fawning over a deal. It's not great.
Yeah. So I'm very comfortable right now. For those of you guys that want to get into deals with me, I'm very comfortable. Under 10 million, I feel very confident that we can close it, no problem. I have all the resources that to take this deal down, no problem. Also, Las Vegas. I'm big right now. My focus is on Las Vegas and also Fort Pierce, like north of West Palm area, from Fort Pierce, Sebastian, all of those areas. So if you're going to send me deals in Alabama or in Mississippi, which I've been receiving a couple deals like that this week, and I'm like, I really don't even want to look at it, because this is where I am. I'm here. This is exactly what I'm telling you right now is the cities I'm interested in is either it's in your backyard, okay? So you know everything about this area and you
Oh,
can be
gotcha.
my boots on the ground, or it's going to be in Fort Pierce, where I have a lot of boots on the ground there, or Vegas, where I'm boots on the ground. Now I have I'm working with a bunch of people, so we have a bunch of, we cover a lot of space. Anywhere in Texas is probably possible, in Georgia and North Carolina, but I don't want to go there right now. If you want to get in a deal with me, the best and easiest way is to bring me a deal, if it's in your backyard or it's in Vegas or it's in the Fort Pierce area in Florida. If you're in those three areas, I will 100% give all my attention to looking at that. Okay, if it's under $10 million, definitely even more interested. And so that's, just to let you guys know, if you want to be in a deal with me, where to focus, right? If you're starting to look at deals in Alabama, it's not your backyard. Even if you find the best deal, I most likely will pass up on it. So just
If you
some
find deals
focus
in
and clarity on there.
Indianapolis, that's what I'm looking for. Indianapolis
Okay,
is our
look at
spot.
that. Boom.
There you go. Or Cleveland, but I don't find a ton of people moving to Cleveland lately.
Okay, so then now adding to my list, if it's also in Indiana and Cleveland, where you're going to be able to work with Tanner on, I would also be interested in that deal because Tanner's in that deal, right? Okay, so that's for you guys to know. What time is it? Okay, we got a little more time. So what else? Anything else that you feel like is happening that people should be aware of? Yeah.
Gosh, let me
What do you
check
think?
my notes, actually. Yeah, inflation was one big thing that I wanted to cover. Really, it's interesting for like my line of business, kind of the end of the year is crazy. We've got a lot of deals that had to close before year end for that 100% bonus depreciation.
Oh man, I know.
And the talk of the town, 100% versus 80%. That's been a big topic lately.
Mhm. So if you guys don't know what that means, in the next couple of weeks before the end of the year, for sure, I will have my CPA come back onto my Monday night call, maybe even on this call, to tell you guys what that means and what you should be doing. All right. So I've had, there is a decent size of so like I told you guys, I've tripled my income this year. So by doing that, I'm not 100% sure right now what I need to be doing with that money and what is kind of expensed out and what's not. So I like to get myself to exactly the point where I don't have to pay any taxes. So it's kind of just sitting there right now. I just have money sitting there waiting to, maybe I have to deploy it into something. Okay, so I'm leaving the storage deal open for myself a little bit in case I need to just quickly put $100,000 somewhere. But for those of you guys that may know somebody, this is also something to start planning as you guys are becoming general partners, understanding the strategy of your money for the sake of taxes. Because once you understand that and you can educate somebody else on that, they're going to invest with you for sure. Okay, because it's not just about, you're showing them not just one deal anymore, you're showing them a strategy of what they should be doing with their money, and that is going to make you an expert in their mind, and they will trust you more. All right, so yeah, this
I would
100%. Yeah.
Another topic, I would just circle back to your Vegas deal. So
Yeah,
unfortunately, it is Freddie, so there's no option for a supplemental, which is huge to know. Whether there's two types of Freddie, small balance and conventional. Neither allows it. The only difference is the size, really. It's just conventional is 7 million and up. SBL, which is small balance lending with Freddie, that's about 7 and below, down to about.
So I'm on that 7 and then below right now.
That's my bread and butter. That's what I've churned through probably 100 of those since I started.
Okay, so tell me what I should be doing on this deal right now. So if I am coming to assume this debt, right, I gotta pay what, 1% assumption?
Yep, 1% assumption fee, so 1% of the loan amount.
Mhm.
And then I would definitely know what you already do, how much longer there is on the IO, and then the full term.
There's no more IO.
Right,
So,
exactly. So no IO,
okay.
then I'd make sure to model that correctly. And
Yep.
then
Uh-huh.
it's really when you can't involve the assumption, it's really, this is how much I've got to raise. There's not a ton of other ways unless you're going to get like a seller carry on top of that. If we start talking about seller carry on agency deals, it gets a little confusing, but it's the same idea. It's seller financing. They
Right. So
would,
this actually is a good idea. Let's
yep,
talk about that for a second. Seller
yep.
carrying. So maybe I can, how, just tell me how in this deal I can raise less money to close this deal than I have to.
Exactly. So one, I think Dr. Holt, I'm not sure if she's on. We actually talked about this on a deal she sent over. Let me pull up my feedback for her.
Nice. Yes, she was one of the people that was looking for your information.
So yeah, so
And she's
technically,
amazing.
yeah, technically Freddie and Fannie won't allow a second mortgage. But
Oh,
what you can do is it technically would be an unsecured note on the property. Their kind of collateral is your ownership interest in the borrowing entity. So kind of the same idea, a little bit different mechanics there, but it can be done. So if you hear someone say no seller financing on agency deals, it is true, but there is a workaround as well.
all right. I like the workaround. So what I'm trying to do here is I'm going to assume this loan. Okay. I mean, the easiest path for me probably is to buy the LLC, right?
Probably, yeah.
And so now going through the assumption of this loan, is my only expense this 1%, 1% for the assumption? So it's like $25,000.
So you'll have
Or
that, and
yeah,
then that's the majority of it. Obviously, you're gonna have like the legal stuff that comes with closing.
yeah.
You'll have your title expenses. There's not many like loan specifically related pieces outside of that assumption fee.
Okay. And so when I go into this deal, obviously I should probably have in my PSA, my contract, some sort of loan contingency on there if we're going to do an assumption.
Yeah, I'm definitely telling everyone no money up hard day one and get a financing contingency. In the past, typically really didn't recommend this, but now sometimes I think it's smart to have an actual rate in there, just simply because I've seen deals with a 200 basis point increase over, maybe if there's an environmental issue or something that delays closing longer than the average timeline, that's when
Mhm.
your interest rate risk is the highest and that financing contingency can save you. A lot of the time the financing contingency is going to run out and you're going to have to make a decision because you haven't closed your loan by then. That's another way that I can kind of add value is I've got the relationship with the lender. They're going to be real with me. Are we going to close this deal or not? And we can be a little bit more certain that a loan's going to close.
Yeah, I know multiple people that didn't have the good relationship and they just thought they were going to close and all these things happened. They ended up not closing and losing a whole bunch of money.
Money gets swiped. Yeah, I've unfortunately seen it a couple times now.
Yeah.
Sometimes it's the lender's fault. Sometimes it's the borrower kind of blinders.
Yeah, I really think this the when it's on the lender's fault, I mean, that just really sucks. I mean, but it really still comes down to you not being prepared and not having the right people on your team to make sure that doesn't happen.
Yep, we
Right?
do
You
our
want
best to
to,
make sure it doesn't.
yeah,
I would say we, especially, and we learned this kind of the hard way, is we've got second and third option lenders. Because if you don't want to lose a deal just because you can't close in time, and
Mhm.
that's kind of what we do is close loans.
Okay. So this finance contingency is usually what, like 90 days, 60 days?
That would be
How long
awesome.
they give that to you?
45 to 60, probably.
45 to 60 days. Okay.
Yep, depends.
So
And
that's really how, that's how
ev-
long,
like,
that's how quick they want you to close the deal, right?
typically, yeah, yeah. Always depends. Right now we're seeing a bunch of gotta close by year end, and it's probably today is the last day that I'm gonna like could take a new deal and feasibly close this year. But starting next week with Thanksgiving and then Christmas, it's hard to close that quickly because so many people are out. It's just
Yeah.
like any other thing, especially with Freddie and Fannie. They are a government agency after all.
Yeah, they don't care. They'll just let you, let your, let your time burn out.
The cutoff for Freddie Mac submission, I think if you want to close before the end of the year, you need to have submitted to them, I think, by next week. If you're
Oh.
submitting all the way in December, there is a possibility that you don't close before the year end.
Submit by next week, huh? Is there a hard date that I can?
Well, it changes
submit?
from like, in submission is once you've pretty much done all of the due diligence. Like, that's not like a term sheet getting signed. That's like we've got our operating agreements, we've got our capital raised, we're ready to go to Freddie Fannie for their, Freddie, typically it's going to be like a 2-week review. It depends. Freddie versus small Freddie versus Fannie versus small Fannie. They all have their little nuances on how long they take to close. If I have to
Yeah.
close very, very quickly, like as soon as possible, I will do small Fannie because of a number of reasons.
Gotcha. Wow. Okay. So this is a whole ton of information. I'm glad that you were on here to help me through my deal that I'm negotiating on right now.
No question.
What questions do you guys have? Anybody have questions here for him? Let's see. You got people that are close to you. Okay,
Nice.
so
I know AJ's also over in Pittsburgh. What's going on, man?
nice. Great. So yeah, I mean, this is
Hands up.
I
All right.
hands up. There we
Jackie, go for it.
Go ahead, Jackie.
Can you hear me?
Yep.
Yeah.
Actually, I wanted to thank you Edo, for giving me the opportunity. I wanted to ask a question related to the LLC when he was talking about LLC. And my question to that, I don't know if it's for him or for Alex.
Mhm.
Can you have an investment, then later on convert it to an LLC, or you have to open an LLC before converting to changing it to your name?
You're going to need the LLC first. You're going to want to go
Yeah.
LLC first. You can, I like my really only experience with seeing someone own a property in their name and then have it transferred to an LLC was single family. If it's ever commercial, I would recommend LLC for sure.
Okay.
Like,
Yeah, I've seen it and I've done it in single family space where we bought it under somebody's name and then transferred to a LLC. That's actually the way that I built my empire back when I did it without my own money. I had other people qualify for the financing, their money, and then I ran the whole thing. We put it in an LLC and we split it 50-50 on all profits. So yeah.
So can you have like one LLC and use it in different states, or it has to be in a particular state, say Houston?
you can use it in different states.
Oh.
You'll have to get a foreign entity operating in that state. So basically it's kind of like opening a new LLC anyways. You have to pay the fees over again, and you're now an LLC that operates in that state.
Okay.
Yeah.
Okay. Thank you.
You're welcome. Thanks for the question. Thanks
You're
for coming.
welcome.
Thanks for being
Thank
here.
you. Hey, good to see you again, Alex.
I know. Good to see you. Go ahead, Nathaniel.
So I just kind of want to make sure I understand, when you say purchase an LLC, you're basically paying the owner what they want to get out of the deal. And then that allows you to basically take that your LLC take ownership of their LLC, correct? Or how, I don't understand because what's the actual technicality when you purchase an LLC? What are you actually purchasing?
So you're literally purchasing everything the LLC owns, okay, including
I'll
its
be right back.
liabilities. Yeah, go for it. So I'll answer this. So when you purchase an LLC, you got a loan. Let's say, so the deal in Vegas, they got a $2.4 million loan. We agree on a $5 million deal. That means I'm purchasing this LLC for $5 million less the debt, because I'm just going to be continuing to pay this debt, right? So it's really $2.6 million. I got to hand to the owner. We have to create.
You got to
like,
raise 2.6 million, whether that be with another loan of some kind or hard money, right?
Well, yeah. So with this Freddie loan, it cannot be another loan. Like, I'd rather not take any other risks on this deal, right? Because I'm already taking the risk of having this property that the
So
bank
you got
is
to
like,
raise
okay,
$2.5 million.
exactly. So that's different. That's that purchasing that property is done that way. Now, if I was to assume this loan, it would probably be the same thing anyways, except I have to pay an extra $25,000. Also, since I may not qualify for this Freddie loan, I have to bring somebody in to qualify for it. That means I got to give up GP percentages for somebody to do that. So this may cost me upwards of $150,000, $200,000 just for that.
I just wanted to make sure I understood that. I understand now. I understood correctly. I just wanted to clarify and make sure I understood correctly.
Yeah. Now the pros of that, sometimes somebody who asked that earlier, is there are a lot of places that they do this type of sale because it doesn't trigger the sale, which increases the taxes on the property.
Yeah, they're not going to reassess it because technically the LLC hasn't changed LLC
Yeah.
hands.
Yeah. So in Vegas, though, they don't assess it based on sales. They don't reappraise. They don't reassess properties. They just have a scale that they go up every year. Doesn't even matter what's happening with the property. If it goes up by hundreds of thousands or millions of dollars, it doesn't matter. It's still just going up incrementally every year. So that doesn't apply in Vegas. But, I want to be able to assume and take over this property without being able to go and qualify for the loan, without the $25,000. Getting Freddie all involved in this deal.
All right.
Yeah. So
I have other
how
questions,
about
but it
some
has to do with acronyms. But I'm just going to look it up on my own. Use the internet.
yeah, cool. How about some resources to learn about the nuances about all these different types of financing? Book, course, website, or just Google? Yeah, I would say Googling is the best, because it's just the fastest way to do it. When you hear a term that you don't understand, write it down. And then you just go on Google, look it up. You can go on YouTube and type it in and somebody will explain it to you. It's just time saving, right? You want to do this, you want to do things in a way that it saves time. So that's what I would say. Eugene, go ahead, brother.
Hey, Alex, with purchasing that LLC, will that trigger a due on sale clause on that loan?
Yeah, so it could. See, that's the only risk about this deal is, when you do things like that. Now, it's done across the country all over. I've done it on single family spaces, and no one's really ever had the due on sale clause called on them unless you were underwater in the first place, right? Unless you were not paying and you were late and things like that were happening, and now they're going to keep an eye on you. You're not a good standing property. A good standing property, it's just sitting on one side of their balance sheet that they don't even need to go and look at. So even my attorney was like, you're pretty safe to do this. In the 25 years he's practiced, he's never had that ever happen. Now it could, right? Because there is some sort of reason, and this is what Tanner actually told me, was there is maybe a little bit of incentive because they would be able to get the loan back at 4.2% and now go charge more for it. But I don't think it would be a big enough difference, because if they were to charge more, that means the asset is going to come down in value if they're going to put a different loan on that. So it's just a process that I don't see them taking. It doesn't make any sense for them to allocate resources to do something like that. So logically, if I was to take over this property, keep it in good standing, nothing should happen. So that is a gamble that I'm willing to take on this property. And Tanner, have you ever seen that happen? And when it does happen, like, How much time do they give you on the sale?
I've not seen that happen. All of my LLC transfers have been either Freddie or Fannie, which they can't call I don't think they have due on sale. I don't think they have that clause in there. Like they can't really call the note like a bank could. If you're assuming a bank loan, I would say that risk is higher.
Wait,
the bank
question.
loans
So
got covered.
if I buy this LLC with this Freddie, there's no due on sale clause?
I'm not an
Can you-
attorney,
can you s-
but I don't
I mean-
think there should be on the loan itself. Like on the
Huh.
loan itself, there shouldn't be one of those. There might be,
Yeah.
but there shouldn't.
Okay. Well, so what do I need to do? I need to go get the loan sheets that the sellers got and look it over there. Is that how I'm supposed to do this?
You
I've
definitely want
never
to
done
look
it
at the
on a
loan
size like
documents.
this.
Yeah, you're definitely going to want to read the loan document, or your attorney read the loan documents. But that's an SBL Freddie loan. My one, like, not concern, but it is still possible if you buy the LLC that Freddie will want to underwrite you for the loan, because realistically, you're going to own the LLC, you're going to own the property, and they're going to want to underwrite you. So I feel like there's going to be some sort of knowledge for them at some point in that process for loan approval, just kind of based on what I've seen. They'll figure
Okay.
it out. They're gonna
So
figure it out.
I mean, if I purchase this LLC, I mean, do they even know that it's happening?
I don't know for sure. I've actually not really done an LLC purchase where you're also keeping the same loan. Most of the time, loan gets paid off. LLC purchase is purely for real estate tax purposes.
Yeah. So
Yeah.
okay, let me.
It's kind of like
I probably will just, yeah, I may just go through the loan assumption for this deal if all this is going to happen anyways. Probably just to avoid all this possible headache anyways.
right. Yeah, I
Yeah.
think that makes sense.
Okay, yeah, I'm gonna do that. Okay, cool. So last thoughts, last questions.
I'm
Tanner,
putting
you
it
want
up
to put
there
your contact info in there one more time?
for sure. I'm putting a couple of the like resources on kind of the Fannie Freddie nuance. A lot of it I've just learned over the years. Not all of it is like published super clearly online, but it is there somewhere.
Okay. This is cool. I think you and I kind of gel pretty well together on these calls. We
Easily.
definitely,
Easily.
yeah, it's pretty fun with you here. I like
Very
it.
natural. Yep. So I put 2 links in there. One's for Fannie, one's for Freddie. The Fannie one's more of a learning center. Like they'll actually kind of walk you through some stuff. The Freddie link is mostly kind of just show different versions of it. If you go to it, you'll see there's the conventional versus small balance. They got a couple other in there that we don't usually talk about, like I think affordable and senior and student, stuff like that.
Yeah. Okay. Sounds good.
And of course, if you ever have questions, just ping me. I'll put my contact
Great.
in one more time.
All right, cool. So yeah, how do you want people to have deal basically all underwritten and ready to go before they contact you? Like, how do you want
Typically,
people to be
yes.
prepared? Okay,
I
good.
would typically want you to have done everything that you think you can do. Whether that's, making sure that your rent comps make sense, whether that's making sure that your construction budget isn't out of this world, just providing support for a lot of the assumptions, because I'm going to have my analyst go through and do his own rent comps. We're going to look at the budget and kind of adjust that based on what we see and know. But having people who are confident and can say, I know this submarket, these rents are cool, here's like 3 similar properties, that goes a long way for me. If you can really show that you know the property and are really interested in it versus kind of just flinging over a rent roll T12. I love seeing deals. So if that's all you got and you're super excited and it's moving really fast, don't not send it. That's what I would say.
Okay, cool. Yeah, I still got to send you the pro forma for our Pierce deal. Yeah,
Perfect.
we've pulled up a lot of different comps, and we are definitely way below market on all the things too. So I believe my
Oh, yeah.
underwriting's pretty conservative, but yeah, we can definitely talk about that after I
Yep.
send it over.
We did the same
Okay, AJ's
thing.
got a question.
Nice.
Yeah, this is actually for Tanner and more of a question. Do you guys loan on student housing, or is it something you Atlas avoids?
I've done a few student housing deals before. It's it's really a different product type. It's kind of like comparing mobile homes to apartments, just because there's a different buyer pool. There's a different kind of credit-ness to it. I saw your email. It's always nice that it's at like a university. Like
Yeah.
if it's a 2,000 student college in a 10,000 person town and it's a 20 unit, that's going to be brutally tough for a lot of different reasons: size, location. Just banks don't love playing in those small areas. But if you're at, Penn State, that's a lot different. The agencies lend pretty low leverage on those. Most of what I've done has been either bank or low leverage after owning it for like a long time. That's
I guess kind of a follow-up question. I'm sure you and I will talk a little bit more about it in detail. 40% capital raise, is that what a lender would be looking at? Or
that's
or
that's
even more?
probably where you'd be starting. Mostly 55 to 60.
Okay.
55 to 60% LTV is what you're going to be seeing. So, 40% raise sounds right.
Cool. Thank you. And I know we'll be talking more about it. So
Definitely.
Nice.
I need to come see a whiteout at Penn State too.
Okay, cool. Anybody else have any questions? Got one minute-ish left that you want to get out there? Cool. Well, I think, personally for me, I got a lot of value out of this call. So I know people here definitely got value. So thank you, brother, for being here.
I get a lot of
Super
value,
appreciate you.
I appreciate everyone
we
for
gotta
hopping
do
on.
more things. Maybe we do a podcast or something like that.
Yeah.
And usually I think I've been missing the Thursday calls a little bit here and there, so it loses steam whenever you miss a week. And then also there's a couple other calls happening at the exact same time today. A lot of competition in the Zoom space now.
No question.
Yeah. Cool.
Awesome.
But thanks for being here and helping and bringing value to the people that are on this call. And thank
No
you all
question.
for being here and trusting and supporting. Really appreciate everybody.